Vishwnath Kane, my colleague CA Kiran Kapadia, and dear friends, good afternoon and welcome to this third technical session on transfer pricing. The subject which we are going to deal with is methods of transfer pricing. Though the words used is methods, but for beginners as well as for somebody who has got decent experience in transfer pricing, I think what is more important is to be aware of the concepts. Unless you know the concepts of each method, it would be very difficult, and at times if you have found that this seems to be the most appropriate method, department has all the way gone on a totally different tangent and come out with something else. I think profit split method is one such area which department has been using frequently. So it will be interesting to learn the concepts of the various methods available, and we have with us Vishwnath Kane to take us through these traditional methods as well as the profit based methods. May I request CA Kiran Kapadia to formally introduce the speaker. Thank you.
Mr. Vishwnath Kane is a Master of Commerce from Mumbai University. He is an associate member of the CA Institute. He is a senior manager transfer pricing with Deloitte Haskins and Sells. He, as a senior manager of Deloitte Transfer Pricing Group, is based in Mumbai and has a very wide experience of more than 17 years in the field of direct tax, indirect tax, international taxation and transfer pricing. At present, Mr. Vishwnath attends to the transfer pricing matters of some of the largest Indian clients and multinational and large corporates. He is also with the Global Transfer Pricing Group of Deloitte. He has been publishing various articles in various journals and financial dailies like Financial Express, Economic Times. He has made various presentations at the Institute of Company Secretaries, various study circles of the Institute of Chartered Accountants, Chamber of Tax Consultants and the BCA. And he has served various sectors, so he has a very wide experience in the field of transfer pricing. May I request you all to welcome him with loud applause. And before I make a request to him to make a presentation, can I ask Manoj to make a offer a bouquet to him or memento to him on behalf of the chamber and all of us present. Thank you very much. Floor is yours, sir.
Good afternoon, friends, and welcome to this very first session after this sumptuous lunch. And before we go to the topic of methods on transfer pricing, I have to find out a method how to keep everybody awake. So, in the morning session, I understand that we have gone through this the introductory part of transfer pricing, that what transfer pricing means, how it has been introduced in India, what was the purpose of introduction of transfer pricing regulations in India, and how it is progressing rather very aggressively in comparison with the very many neighboring countries or even the leading countries of the world, namely US, Germany, UK, Japan and Australia. So basic purpose of transfer pricing, as you must have said, is to check the profit shifting, that is from India to other maybe low tax jurisdictions or tax havens, and to protect the revenue base of India. That is the whole purpose of transfer pricing regulations, just to summarize in one line. With this object, the government introduced the regulations, and it is not the end in itself. When the regulation is introduced, there has to be a mechanism. The mandate given to the taxpayer under the regulations is that their international transactions, or one can say cross-border transactions, have to be at arm's length. Whatever may be the nature of transaction, you can name the transaction, it is covered under the Indian transfer pricing regulations. So that is the whole ambit of the transfer pricing regulations. So just to enable the taxpayer to discharge its burden of proving that all the transactions which are covered under transfer pricing regulations are at arm's length, there has to be some mechanism because without mechanism, how the taxpayer will be able to demonstrate that all transactions what he is entering into or has entered into are actually at arm's length. Though they may be actually at arm's length, but he has to demonstrate to the tax authorities that they are in fact at arm's length. So it's not that just transaction is at arm's length is enough, but it has to be proven or demonstrated before the tax authorities that they are in fact at arm's length. So with this object, government has introduced these methods, what is called generally transfer pricing methods or TP methodologies for analyzing the arm's length nature of the cross-border transactions or international transactions. See, for sake of simplicity, we have just divide this discussion in these various sub-segments, I should say. And we'll just try to touch base on each of the aspects of each method. And before we go to each method, this is the summary of what we have learned or understood in the morning session, that one associated enterprise in India having transaction with the overseas enterprise and the transaction has to be at arm's length. That is the mandate given in the regulations. As I said, there are various methods prescribed by the government, and that is a part of our transfer pricing regulations. And we are not going to the various sections and subsections or clauses because that will confuse the people, and unnecessary going to the technicality, it doesn't help. We have to understand what is the method, how it is to be applied in the given context, and how it could be useful in different types of industries, what we are dealing in on a day-to-day basis. So these transfer pricing methods are generally classified in two parts that way though. That way, if you see that main categories are traditional transaction methods and transactional profit methods. Residuary method, though it is indicated here as a separate category, is virtually a part of transfer pricing profit-based methods. In this session, we are supposed to discuss the first part, namely the traditional transactions methods, which are comparable and controlled price, resale price, and cost plus method. So we'll be dealing in this session only with these three. My subsequent speaker will be dealing on the other two, profit split and TNMM. So before we go to each of these three methods, we need to understand, as I said, government has prescribed these 5 methods to enable the taxpayer to demonstrate that the transactions are actually at arm's length, or if the results are different than the arm's length, the taxpayer is required to explain the reasons why the prices are differing from arm's length price. Before we go to these methods, let us understand what is the hierarchy of this method. Is there any hierarchy prescribed in the regulation that you start with first method and end with the last method, or you can choose any of the methods? So here the main clarification we need to remember that in Indian regulations there is no hierarchy of methods. There are 5 prescribed methods as of now. Out of that, you are, or the taxpayer is entitled to select any of the method which is considered as the most appropriate method in the given context. We'll see that what most appropriate method means and at what criteria this method has to be selected. But at least this point of time we should remember that there is no hierarchy of method, that you start with CUP, then go to resale price, then you check cost plus, or then you apply TNMM, nothing of the sort. What is the availability of data, what is the transaction, what needs to be benchmarked, how we need to demonstrate the arm's length nature, that much freedom is given to the taxpayer to select any of these 5 methods which is considered as the most appropriate method. If I'm going very fast, please let me know so that we can somewhat reduce the speed. Well, I know this is a new topic and we need to understand rather than just completing the session. Now these methodologies, in the morning session we must have learned, there is a OECD transfer pricing guideline which is considered as a Bible for everybody. That guideline is for multinationals and even the tax authorities to understand and implement the transfer pricing regulations world across. There is a guidance given to the OECD member countries, but India is still not a member of the OECD, but still it is imperative and it is required, and in some of the decisions in Indian courts, it has been held that in absence of clear guidelines from the CBDT as far as Indian transfer pricing regulations are concerned, we can rely on some of the comments of the OECD. So that is the weight we have to see as far as the Indian transfer pricing regulations is concerned when we talk about the OECD transfer pricing guidelines. So here the methods, fortunately, what you are available in our context, that is Indian transfer pricing regulations, are almost the same what has been prescribed under OECD transfer pricing guidelines. Now, which are the rules which deal with the transfer pricing methods in the Indian regulations? Namely, Rule 10B and 10AB describe these different 5 methods what we are going to discuss. Another thing what can come to anybody's mind, now let us say there are 2 different methods possible in given context. It's quite possible in given circumstances 2 methods may be applicable. Of course, I know that we are not discussing at this stage that what is the real method, but hypothetically one can consider out of these 5 methods, 2 methods may be considered as most appropriate methods, and in that case, if the results are given by the 2 different methods, or where last bullet I am referring, where more than one method can be applied, the ALP shall be calculated on average mean of all such computations. So we just referred to the concept of what is known as most appropriate method. So when I mention there are 5 methods, and assessee or the taxpayer is given the freedom or liberty to choose any of these methods as one of the most appropriate method in the given context where the analysis of this transaction has to take place. So what factors we need to see? That is also considered in our regulations. What are the guidelines, so to say? How to go that about the selection of this most appropriate method? That guidance is given in Rule 10C. If you see on the top of the slide, the heading itself, selection of the most appropriate method, or MAM, what is generally referred to as section. Actually, the section is not there. Actually, you should be reading Rule 10C, not the section. Here, one has to consider different categories or the criteria what the taxpayer or the consultant needs to have a look at before any method is selected as the most appropriate method. Then this I am just referring here because that will be more evident when you discuss the method parts. Nature and class is the important thing. Then which are the types of enterprises we are talking about in the international transaction, that also matters because you are talking of the level of the market. Then availability of the data, that is a prerequisite for selecting any method as the most appropriate method, because hypothetically one can select any of the 5, but if the relevant data for applying that method is not available, then it cannot be considered as the most appropriate method. Even it cannot be a method also in that case, forget about most appropriate method. Then what is the comparability between the 2 categories of transaction? What you are trying to compare in transfer pricing is controlled transaction versus uncontrolled transactions. So what is the comparability aspect between this controlled and uncontrolled transaction? That also is one of the criteria. If these 2 transactions are not comparable having regard to one of the methods, that method cannot be considered as the most appropriate method. And there has to be reliable and accurate adjustment possible. If let us say when you are trying to apply one particular method, the results are divergent, giving some difference. So that doesn't by itself mean that assessee or taxpayer is not complying with the arm's length nature of the transactions. There are some adjustment possible, how to reduce the gap by giving some economic and business rationale why the margin which is computed by applying one particular method needs to be revised for all practical comparison purposes. That is considered in the reliable and accurate adjustments. And lastly, the extent of assumptions, because in transfer pricing one has to see that it is not an exact sign. It cannot be 1 + 1 = 2. It can be 1 + 1 = 4, 10, whatever. In transfer pricing it is very subjective. You have to apply your creativity, because just having the data or the method, that doesn't suffice. You have to apply your mind, you have to explain the business case, how the method can be applied in a given context, and what are the general conclusions can be drawn. It just can be compared with the person going to the astrologer. Now there are many astrologers who can use the computerized Janam Patri. You go 100 rupees the charge, and he will give the date and he will give the printout, and everybody's fortune is the same. So here it is not the case. Here the method also can give the same results, but one has to apply the business case, that how you are going to explain that result. Just a third party may not be able to understand whether this result is really giving the correct desirable conclusions, because one has to see the background of the analysis, what the method is selected, how it is applied, what data has been used, what assumptions have been made. That's why this slide is very important, because the guidance given in Rule 10C, in fact, unfortunately, CBT has not given any further guidance on how to apply the method. This is the only guidance we have in Rule 10C, that how the most appropriate method can be selected. In fact, I might share with you that when these transfer pricing regulations were planned in India in year 2001, after the special group recommended the introduction of the transfer pricing regulations. It was expected that CBDT will be issuing some detailed guidelines on each method by giving some examples. If you see the US transfer pricing regulations, it has some examples for each method, how the method is supposed to be applied. Unfortunately, that is not done in our context. Maybe in future one can expect. Now after 10 or 12 years of operation, still nothing has come, but let us hope for the best. By that time everybody will be expert in transfer pricing and they can suggest which are the examples to be included. So this, what I have included in the earlier slide, I'm just categorizing in the 3 different segments, that what assumptions or what things we need to look at. One is comparability of control transactions. In that we mean what are the different functions or property and characteristics of services, etc. Then functions performed, risk borne, and I don't want to bore with the same discussion what we had in the morning, that function analysis, the cornerstone of any transfer pricing analysis, is the heart of analyzing comparability search, and that is dependent on the function analysis, where we need to analyze functions, assets, and risk part for assessee in India as well as its overseas associated enterprise. Then we see the data information. If you see the earlier slide, I have mentioned that availability of data was one of the criteria. The same thing is categorized here. And last is the purpose of its application. As I said, for what purpose this analysis is going to be done, because this analysis, fortunately in Indian context or anywhere in the global countries, wherever we have the transfer pricing regulations, there is no separate method for planning. There is no separate for advisory. There is no separate for compliance. For all things taken together, these are the 5 methods. And globally it has been accepted almost in all countries. These are the 5 recognized methods. So advantage of this is that from transfer pricing specialist perspective, anybody working on transfer pricing, and anybody is that way, where he has the opportunity of going abroad, he can work from the day one only. Here we have to learn in, if you have to apply direct tax regulations, one cannot go overseas and apply direct tax of the local country. But advantage of transfer pricing is that even if you are posted from here to UK, US, Australia, wherever in the world, you are ready to work on the day one. Because almost all countries are having the similar regulations. Some changes will be there, definitely local requirements, but broadly, as far as the methods are concerned, analysis is concerned, is broadly remaining the same across the world. So the transfer pricing specialists naturally have the high mobility. Now coming to the methods proper, as I said, we'll be discussing 3 methods which are categorized as traditional methods. Now first, just let us begin with a simple example without going to the nitty-gritties of the method and all that. Let us say we want to buy a television set in Indian context. It is a normal thing we buy, domestic appliance, that everybody has television sets in everybody's home. One may be having Daewoo, one may having LG, anything, or Sony Bravia, whatever it is. Normally a person, when he or the family wants to decide the purchase of this television set, what factors the family or the members will consider? Anybody? Anybody? It's a very general question. It's not. It's very technical. Yes? Color quality. Next? Brand value. Then? Costing. Warranty. Yes? Correct. Anything else? Brand. Yes? After sales. Yes, obviously. Nobody talks about cost. No, yeah, owners also pride. But price is not a criteria. Nobody wants to consider price as a criteria, or is it automatic fallout? And then once you decide this internally within family, you go to the shop. What type of inquiries you will make? You go to the shop and decide, okay, this is my final choice, I will buy it. Or how you go about this purchase? Correct? Internet is one option. Yes? You do, see, you can try different shops, you can inquire the price, how much discount is offered, and this variety of factors for your concern. See, here, nothing different. Don't that way bogged down by cup method and resale price and cost method. These are all routine matters. We have to just understand how to apply it in a given context. Here we are day in, day out, we are doing this transfer pricing method in a normal way. As I said, in example of TV, one has to consider a variety of criteria. If just you go to the earlier slide when I said, what are the comparability factors? You can just see and compare what you have just said in matches with here. First, characteristic of property or service. What type of television set you want? One said color combination, one said sound, one said it should be clear picture. Then so many things can be attributed to the TV quality as such, or specifications one can say. It should be size, all this. It should be maximum which is available in the domestic market. Functions performed, what it can say, whether the internet is possible to connect, where it can attach some iPod, iPad, everything that can be connected to the TV set. You can download pictures, you can record pictures, or you can see your video games on that. All these things come in the functions performed by the appliance, correct? Then it comes to the respawn. One said the warranty and after sales service. So here, let us say we buy Sony Bravia today. After a year, after the warranty is over, and generally happens after warranty over only, it suddenly breaks down. And when the technician comes, he will be telling you cost is not more than 50,000 rupees. The cost of the equipment originally was 1 lakh rupees, and part of whatever, motherboard gone or whatever, 50,000 rupees. So if that is the thing, that matters this risk bond. So here we have to just apply in the given context of international transactions. These are the variety of things we have just noted. In case of purchase of this normal purchase of television set by a family, you have to do all this exercise. Same is to be expected when a person in India or the enterprise in India is having a transaction with overseas associate. That is associated enterprise. It can be a parent, it can be a subsidiary, it can be a joint venture, whatnot. So many legal forms may be there. So all these transactions which are happening between country A and country B, if they are happening between the group enterprises which are defined and which are considered as associate enterprises for the purpose of transfer pricing regulations in India, when you apply CUP, all these factors need to be considered. So in short, what we are trying to compare in the CUP method, let us say, here by example. Now let us say a manufacturer in India, correct? It has got a transaction with overseas related party. On the top it is mentioned. And the same manufacturer in India also has a transaction with totally unrelated enterprise, correct? So what you are trying to say, the identical product or service which is being provided or sold by manufacturer A in India to its related party, maybe let us say in US, that transaction is a subject matter of transfer pricing analysis under the transfer pricing regulations in India. So we have to demonstrate as a taxpayer that whatever price manufacturer is charging to related party for this transaction of sale of goods or provision of services, that is at arm's length. That is the mandate given under the regulation to the taxpayer. So in this context, particular context, manufacturer is having transaction with both related party as well as unrelated party in the same country. We don't want to elaborate the further consequences of going to the other country. There are some other aspects we consider. But let us, as a beginner, we understand what is the whole concept about and the application of CUP. So here what we'll say that finished goods which is being sold by manufacturer to related party, let us say at $100. It is also selling the goods to a non-related party in the same country, that is US, maybe at $120. So what the transfer pricing officers will understand from India perspective, that you are undercharging your related party. What is the net impact of this undercharging? Because you are able to charge 120 to your unrelated party, so non-group entity you are charging 120, but for group entity you are charging less price. So what is the end result in Indian context? Can anybody? Based on just morning discussion, we are charging something less to our related party overseas. What can be the impact? Anybody one at a time? Correct? What sort of rebate adjustment? Why? So you have explained the CUP method, right? This is nothing but CUP method. They want to apply the same category of transaction, same identical goods which are sold to related party vis-a-vis an unrelated party. If there is a price difference which is not being able to be explained by the taxpayer logically, given the business case and other economic reasons, that difference of $20 will be added back in the hands of the taxpayer in India as a transfer pricing adjustment. And what do you mean by transfer pricing adjustment? It will be added to the total assessed income. On that, you have to compute the relevant tax liability. That is the end result. So here, CUP method tries to compare what is the price charged by the manufacturer to the related party vis-a-vis the unrelated party in the same country. Now, this we talked about the internal CUP in the sense that the same manufacturer is having transaction with both related as well as unrelated enterprise overseas. Now, second variation of this CUP method is the external CUP. What we mean by external CUP? Here let us say Inco, that is a company in India, is a subsidiary, let us say, of US Co. And Inco is selling goods to its parent in US. There is another company which is an independent company, so which is not part of the group at all, which is based in China. This China company is also selling the identical goods to a third party based in US. Correct? So what you have to remember, the product dealt with by both Inco as well as independent company in China are identical. There is no difference whatsoever. Just for understanding what you say, that when cup is to be applied, when the products are identical. When there is a change in characteristics, it is not possible to apply cup, because once you change one single characteristic, it has the major impact of having change on the prices. So the basic given fact or the condition is for application of cup is the product or service has to be identical when you try to apply whether internal cup or the external cup. So here in the external cup, what is being compared is the transaction to be analyzed or control transaction is transaction between Inco and US Co. There Inco has to demonstrate as a taxpayer in India that transaction with its parents are arm's length. That is, whatever it is selling to the US company is arm's length. So there what one has to understand is, if China company is selling the same goods to company Y, which is an independent party in US, one has to compare the prices charged by Inco to US vis-a-vis the price charged by China entity to a third party in Y. If Indian company is charging less than what China is charging to a third party, naturally again Indian entity will be suffering transfer pricing adjustment at India. Correct? The same example what we discussed, if Inco is charging $100 to USK, whereas China is charging, let us say, 120, Indian entity is charging something less, that is by $20, that will be again added as a part of the income of Indian entity. So this is called external cup, where Inco is not having a transaction with third party, it's totally a third party which is having a transaction with another third party. But we are taking for the sake of convenience that both the things are sold to a customer in US only. Either in one case the US company, the other is the independent party. So that is the precondition when you apply this cup method, whether it's internal cup or external cup. Anybody has any doubt? We can move ahead. That may not be able to be compared in the sense that the geographical difference one has to consider. That's why you are taking the end market where you are selling the goods. If China entity is going to sell the goods in India, it may not that way get the same price what you would have otherwise got if it is selling the goods in US market. Because the geographical difference matters. If let us say, for your just for answering your query, that if India is, let us say, selling t-shirts in India, the t-shirt may be costing 300 rupees, but India company will not be selling the same t-shirt in US at 300 rupees, either virtually $5. It will be about $50 in US. So that is the thing, that India itself will not be selling the product at the same price in US. So that is why it is not possible to compare China sales to India. See, that's what when I say that, first of all, as I said, when applying a cup method, what is the given condition is product should be identical and the geographical difference needs to be adjusted, because the cost of production also matters. It's not that India company sells at certain US customer and China is already dumping the goods, because there are many other regulations also need to be considered. China's, as you rightly say, cost of production may be less, they are able to sell it at less price. But in that sense, we have to see that India price also should be somewhat near vicinity at least. At least one can say some geographical adjustment should be given, or any cost of production adjustment also is possible. That's why I'm saying when you apply cup, it is not possible to apply straight away. There are some adjustments warranted when you are considering from export from one country to other in a totally different geography. So you can't compare straight away when China export to India as the base for analyzing India's export to US. There will be some lot of adjustments required for making it comparable. Okay?
When there is a company in India wherein it is selling to US, so whether this comparison with China can be made, because there is a company which is exporting to US.
Yes.
Whether it is possible based on this, you are saying independent company in China. So if Indian example is available, whether this is feasible and acceptable?
Of course it is possible. In fact, this is used by the taxpayer in department for defending the audit matters.
But there are examples available in India which are exporting the same products to US.
See, if that is available, nothing like it. If identical products are being exported by India to US, that would be great. One has to compare that as the first option. See, this is the thing one has to just explain, that I am just saying example in China, it can be exported from India also. Only for sake of convenience, I am saying that this type of comparison is also possible. The third party comparison can be from India to US also. I am not saying ruling out that possibility.
We take one more example, like from India there are 100 more exporters. So which data needs to be compared and what will be the relevance out of it?
See, your question is right. That first of all, what I understand is you are coming to the how you can get the relevant data. First of all,
Yeah.
that is the thing. The same thing happening with China also. Why I took China is because US is able to give the customs data. Because when I tell that China is exporting to US, naturally for US it is an import. So US custom data is available in the public domain. We can find out what are the total imports coming into US of the same products or identical products. So from India perspective, just to answer query, that is not easy to identify which are the third party manufacturers selling the identical goods, but that you can utilize the custom data. There are some softwares coming in the market now which are linked or which are giving the information based on the custom data, which indicate the import also in India as well as the export from India. So that type of information now started becoming available.
Now my view was like out of 100 exporters, we take out the data of 5 exporters which are favorable to us. Others we leave. So TPO might not agree to it.
You are already a transfer pricing expert. But unfortunately what happens that first of all you have to remember that the data which you are going to use for analysis, for CUP or any other method, that has to be available in the public domain. That is the mandate given in regulations. Just because you know some CFO, I know some CFO, I just request him that okay, you give me the data of your products, what you are exporting in the same country where I am exporting, that is not going to be accepted in the department. Just your relationship doesn't help. It has to be available in the public domain. The tax authorities also should be able to verify that data. So that is the precondition. So how you identify is the issue. We can utilize this, as I said, some of the softwares are coming in the market which give this information, that is price information. Earlier what we have in Prowess and Capitaline, you must be knowing, that is giving the margin information generally. But here there are some softwares which are coming in the market, as I said, which are giving information on the product imported and product exported based on this HSN code generally. So that is the criteria for this customs valuation and other things. One I know is the TIPS software, which is giving this information. And the other one is ACE or something. TIPS. Yes, sir? See, there are conflicting views. I will be just taking on this, what are the decisions which are in favor and which are in against. As far as this, you have valid query that some cases they have raised the issue, because what happens in case of TIPS software, unfortunately the data is available for product and other details are there, but the name of the entity is missing in the TIPS software. That is maybe in the case of importer, if you want to imply that data for analysis purpose, what they require is the importer's name, which is unfortunately missing in that database. I don't know what are the reasons. They may be that we prohibited to publish, I am not sure, but that is the case. Yeah, so that data, importer's name is not there. On this technical ground, the tax authorities are inclined to reject this TIPS software. But there are some cases where TIPS software has been accepted. So there are conflicting views as far as the acceptance of TIPS software is concerned.
Sir, there are situations where the cost of production also needs to exist, because take an example of legal diamonds and bloody diamonds. Now, in those kind of situations, naturally, the blood diamonds will be cheaper. But how would we know whether the China has exported, which is those kind of things? Or
See, sir, actually what I am giving is China is only the example.
no, I understand,
See,
but any other
one has to just see.
we would not know. Like
No, what I am saying, your query is right, that how to get that data and what type of adjustments are to be made. See, important thing we need to see that when we are applying CUP, you are comparing the price, not the that way margin what the Indian entity is earning. It may be incurring losses also. That is the beauty of this CUP method. When let us say Indian entity in losses, maybe diamond trader or whatever. If they are on net level, they are in losses, but their only transaction, that is international transaction, is export of diamonds. What is tried to compare is the price of the diamonds which are exported. That itself will be a subjective case in case of diamond industry. Because each diamond, one has said that it has got different criteria. I can say this is valued 1 lakh rupees, one can say it is valued 10 lakh rupees. There is some sort of subjectivity in the pricing of the diamond itself. So it may not be easy to apply cup in this given context. At your query is right at how to adjust the cost, but that you can say when you are applying the cost plus or TNMM method, there are cases where the tribunal also accepted that, now let us say capacity utilization. If taxpayers' capacity utilization, let us say 30%, compared with the other manufacturers or traders which are having 100% utilization of the capacity, one cannot say that taxpayer will be having margin at all, because there will be under recovery of fixed overheads. One cannot be expected to have the positive margin at all. So that type of arrangement tax authorities are inclined to consider, provided it is properly backed up by the documentation. They need some certification of the cost, that way capacity utilization, maybe from the engineer or some authority, that this is the actually installed capacity and what is the actual utilized capacity. On that basis, they grant some sort of adjustment to revise the cost of operation and rework the margin of the taxpayer. Similar case, it will be the case of, in case of this accelerated depreciation. Many companies are using accelerated depreciation, which is higher rate of depreciation than prescribed under company law. So what is the net impact is that net margin of Indian company or the taxpayer dips because of the excess depreciation claim. So that type of adjustment is also possible, provided you give the detailed summaries and submission and getting the analysis. So how to rework the cost, and the reasons are to be authentic. Now, this method, where it can be useful, because we have just understood how the method operates, but where it can be used, that is important. Here, one can think of sale and purchase of goods, that is maybe trading of goods or sale of finished goods, maybe payment of interest rate or receipt of interest rate. That is, we can have this cup method. We can use the LIBOR, RBI rate or PLR rate. But there are a variety of things one can say, LIBOR plus, like 3 months LIBOR, 6 months LIBOR, 9 months LIBOR. There are a variety of things one consider depending on the case to case basis. That is for benchmarking the interest either paid or received. Same thing in case of royalty, because these will be on the same royalty also. There is a database available for identifying the third party comparables, because as you rightly said, how to find out the third party comparables. Now let us say in case of event of royalty, we need to say that okay, Indian entity is paying royalty of 5% on sales. So how to say that this 5% itself is an arm's length? Now one can say that I have got RBI permission to remit the amount, that itself says that this is arm's length. But unfortunately it is not true from transfer pricing perspective. That is one limb of it. One can use it as a persuasive value, that RBI approval is itself is giving some indication that we are not paying something excess. But that does not mean meet the end, because RBI is giving, okay, this is the maximum margin rate you can pay. That doesn't mean that you have to pay 5%. They may say, okay, broadly this is the maximum you can pay. One has to just, on facts, one has to demonstrate that 5% is really at arm's length. For that purpose, one needs to demonstrate that rate itself is correct. So here we have got fortunately one software, the database, what is called royalty stat database, is a paid database, but one can subscribe and get the relevant information on the third party comparables which are in the same line of business and having similar type of agreements, and where the royalty has been paid accordingly. Same thing is case of the guarantee fee benchmarking also. Now let us say Indian entities either charge, yes sir, royalty stat. Same thing is applicable also guarantee benchmarking. There you have to use this other that way databases available. Now when I explained this cup method, as I said, we took the example of that way purchase of TV sets. You can just link up, these are the variety of things one needs to consider when you want to select cup as the most appropriate method. Just to answer what he has said earlier, that geographic market, how it makes difference, that is the first criteria, geographic market in which the transaction takes place, that itself makes the huge difference as far as the pricing is concerned. So whether to use a particular transaction as a cup has to be demonstrated or considered only after considering the geographical difference. Because what happens is you are choosing a different country, the standard of living of that country itself may be different. That's why you are able to sell at a much higher price. The forex exchange will be having major impact. The level of development will be having impact. So all these factors need to be considered when you are selecting a particular geography for comparison purposes. Now let us say volume. If you are purchasing one television set for your own use, they may not be able to give hefty discount. But if you want to buy as a group, I want 10, 50 sets, one can consider some discount. That is volume driven. So that also aspect has to be considered when you have transaction between two countries, that way, which are to be proved at arm's length price. So there are a variety of things one can consider, maybe contractual terms, that when Indian entity will be making payment or when Indian entity will be getting the payment, because one can say my price will be such and such in both the context, that related party as well as unrelated party, it may be $100 each. But one distinguishing factor will be, I will be granting very excessive credit period to related party vis-a-vis the third party. Now let us say if 100 is the base price for both related party as well as unrelated party, if I give 120 days credit to related party vis-a-vis 30 days of credit to the unrelated party, I am giving some excess credit of 90 days. So naturally it doesn't come free. In business world nothing is free. So this 90 days of extra credit has some imputed cost of interest. So that is the benefit we are passing on, that instead of 30 days credit, I am giving very excessive credit period to the related party, namely 120 days. So for 90 days they are enjoying some extra credit which has some imputed cost of interest that needs to be adjusted for comparison purposes. Now, as we have just discussed, what are the method we are in the application and where it is applied, then it has lot of problems also. When I say cup is not readily available, we have to make efforts. In fact, when I was in Australia for my learning on this transfer pricing, my partner there used to say many times, if you find a cup, you take a photograph and put it on the frame. That sort of a thing that he was referring that time over 10 years back when he was talking about the cup method, when we were introducing transfer regulations in India. So that is the rarity he was explaining. Cup is rare. But unfortunately, tax authorities across the world are after cup. And on the contrary, taxpayers are on the world basis also, they are trying TNMM. But none of the method is applicable. I am going to residual method, TNMM method. So that is the conflict, another conflict between the taxpayer and the tax authority. One saying cup is the only method, rather most appropriate method. In most of the cases they try to apply, whether it is royalty or sale of goods or whatever you can think of, management charges or even any other thing, tax authority will first try to find out whether cup is applicable. And on the contrary, as I said, taxpayer will be more inclined to go TNMM because it's somewhat liberal method. Of course, it has some advantages and disadvantages of its own also. So here in application of cup, one has to remember insufficient market transparency for identifying comparable companies. As you rightly said, if we have to identify companies operating in India, dealing in the same identical product, that is a big task on hand. It is not easy to identify those type of comparables which are again required to be in the public domain. I don't know how many things will be available to us for analyzing on cup basis. That is the important criteria we need to remember while selecting cup as the most appropriate method. Second difficulty is to accomplish necessary adjustment calculations. As we just discussed, whether it is possible to apply different geographies for comparison purposes, China to US, India to US, whether these geographies can be considered, yes, it can be considered, but it should be with some sort of adjustment because of the geographical differences. So that becomes another big economic analysis, how to make this adjustment for differences in the geographies, which I will consider for cup analysis. And some adjustments calculation even seem to be mutually contradictory. That is another problem, but that is a technical thing we need not go. Basically, you have to remember cup is not easy to apply because of paucity of data and different type of adjustments that we need to make. Okay. These are the just for reference purpose, you can read later that which are the relevant cases we can think just as a flavor that what the tax authorities in India are doing as far as cup is application is concerned. As I said in the earlier, just two minutes back, that tax authorities generally prefer cup. This is the relevant case, Sardia Pharmaceutical, where the TPO has preferred or applied cup over the TNMM method. Taxpayer wanted to apply TNMM, TPO said no, it should be the cup method. As I said, that's why there are many. Yes, please. Yes.
they might be similar. So two products are never same. Maybe if you compare mobile, television, everything, from one company to another company, there might be some variation in that as per their technology or features. Or so anytime TPO will say ki these are not same. This is having this features and this is having this feature. So per se, how to compare when you can say though no two products are same, how you can apply cup?
See, that's what I'm saying. Cup is having application in case of very identical goods. Now let us say TV brands.
Yeah.
Internal cup we can apply. Let us say company in India purchases Sony Bravia from Japan company. They will be selling to third parties also, assuming. So there we can apply cup straight away. That's
But
why this,
external cup might not be possible.
yes. See, one has to see because unfortunately, real business world, what happens if Japan is having a Indian subsidiary, they may not sell directly to third party customers in India. That is the general they follow. If you see in the practical front, it is easy to understand external cup that way that Japan exports to third party in India, but generally that doesn't happen in real well because they have a subsidiary, they will be routing all the transactions to the subsidiary. So that direct cup or external cup or internal cup even may not be available.
Achha, one more question. It was regarding
No,
previous
just to
thing.
complete your query, that in that situation, what can happen? You are right that products are not identical or they are not same because competing products they have different features. Now Android technology, Belgian technology, whatever that we can introduce, it will have the impact on the price. That's why I made it the first condition that when you apply this cup, we have to see what are the different criteria. These are the things we once you say that basic characteristics changing, naturally the price will change. So it doesn't become real comparable at all. We cannot apply cup in that given context. We have to think of some other opportunities. Now let us say in your context, when you are saying that we are importing something from Japan, let us say, here cup may not be the right method, but you can still try to consider resale price. But the resale price comparing the gross profit margin, not the price itself. So that will come into the resale price. We'll just explain that.
So one more question regarding public domain. What is to be considered as a public domain? Say I have a cost audit report of some company. Whether I can consider that as a public domain or a balance sheet of a private limited company?
Strictly speaking, I won't consider, if it is a BSE listed company, one can say yes, that is the public domain. Because the TPO can access
I'm
that
saying
data.
it is not BSE listed, some private limited.
I doubt because see what happens is, and since you are
No,
talking
but I have a balance sheet audited.
no, you may be having because of your relationship with CFO, that's what I said earlier. Maybe you see your friend or even benchmate in the college that he might have shared in confidence, which you can't use in your analysis because this is going to be present to the tax authority and tax authority, he himself doesn't have access to that information. Of course, by 133 notice, he can issue and get that information, whatever data you have submitted. But that is something future. As far as the regulation is concerned, you can't apply some data which is not available in the public domain. Only thing is that now let us say, if you are doing a search process, let us say, as you are just referring to ROC data, we can definitely apply because private companies' data may not be available on the web. They are not listed on the BSE stock exchange. If you think that these are my real comparables, we can approach ROC. But there is a method how to see. Just because you know this is my competitor, so that doesn't mean that I should get that data and end of the story. We have to see because then it gives the right to the some taxpayer which is smart enough. Okay, two comparables which are favorable, they will get it from ROC, but other two which are against, they will not get it from ROC. So there has to be some structured source process how to identify these very comparables. We are going to be taken from the ROC. Now, coming to this, okay, can we move to resale price? Yes, please.
How will I benchmark the transaction which are relating to say I have advanced the loan and on that I have suppose charge a interest rate. Now how will I get the comparable uncontrolled rate of interest for what interest rate I have charged from the public domain, or say because there is no internal cup available because it was not my business to grant the loans to any A's or non-A's, but simply because of any commercial reason I just gave the loan to my associate enterprises and now internal cup is not available. So in that case,
the answer to all these type of things, it is maybe interest rate or royalty rate. There are different types of publicly available databases on subscription basis, not that it is freely available, but there are databases available which can give this information on what is the rate charge in identical or similar circumstances. particularly LIBOR plus, because it's an international transaction. It cannot be at the same India rate. It will be at LIBOR plus rate. What is LIBOR is available 3 months, 6 months, whatever. Plus there will be some additional amount which is a premium. That rate can be obtained from the publicly available databases.
But generally, the TPO issues the show cause notice saying that he has computed the interest rate based on
CRISIL.
some credit ratings, CRISIL or some based on that. So in that scenario, how will I fight with them?
No, but at least, see, apart from getting the information of CRISIL, he has to make that information available to you. You don't have to go to CRISIL for getting the information. When TPO wants to utilize that data against the SSE, first he has to share that data, whatever is obtained. Then we can have the question on this, whether it is right or wrong. You can also access to the CRISIL database in that case. If you are eager to object to the TPO's observations, first of all, you can find out many flaws in the TPO's observations as well. In spite of getting the data from CRISIL, there will be some different assumptions made by TPO that also can be challenged. Because not that CRISIL data will be applied in the same context in the way we understand, right? Yeah. It is a standard one. We cannot apply in each and every case the way the CRISIL applies. It has to be modified to the extent explanation varies. What type of different analysis one has to consider.
Because whatever the ratings he has supplied to a particular loan transaction, say BB plus or A plus whatsoever. So that kind of a rating I won't be able to
correct, but that's what I'm saying. It's just not coming from only CRISIL data. It is the decision of the tax authority which is categorizing you as a BB or BB plus. It's not the CRISIL is saying that you categorize yourself as BB plus or BB. It is the finding of the TPO. That's why I'm saying only data is not the thing, but how it is applied by TPO, that also matters. Because in your given context, we have to see what different assumptions he is making for analyzing using this CRISIL data.
And sir, one more question. In case of a property, residential property or commercial property, if there is a cost contribution sort of agreement by a parent company and a particular on the basis of square feet or etc. some FSI, based on that some rent has been distributed to their parent to their subsidiary companies or group companies. Now in that case,
would you see property situated in India where the SSE is situated, or how you are saying?
That commercial property situated in India,
okay.
It is something in related to SDT. I mean, it is in relation to method only. So wherein the commercial property is situated in India and the entire cost of that rent is being paid by a parent company.
Which allocated to other group companies.
To other group companies. Now, in that case, is there any database or something available wherein I can judge or I can say that whatever rent I have incurred is
no, right now that data is not available. You are going many steps ahead. That much information is really not available. SGD came only in last year, that March 13. So people will be working on that to get the specific information. But there are ways of how to justify this payment from the group company to the parent. What is the allocated portion? That one can work out. It's not that it is to be left without analysis.
No, because the entire property is owned by only one of the company. If
that is right, but other companies are using that property, right?
Yeah.
Maybe having some office space or something. But there are ways how to justify the payment from these group companies to the parent. May not be available on database, but we can devise the method how it can be justified at arm's length. Yes, that's what I'm saying, that there are many other ways where here people are already experts in transfer processing. So, in fact, it will be intensive training for me, it seems. It's the way things are moving. Okay, let us take it offline. We'll just, of course, that one can consider these are the valid method, but there are some precautions to be taken. Just because it's available on database, one cannot say that this should be applied. Yeah, now let us come to the other method, the resale price. In fact, in our context, there is TP regulations in India. This is the only method which says that it is having only one-way application. In the sense that if Indian entity buys the goods from his group entity overseas for resale in India, not for his own use. If let us say Indian entity having a trading business, it imports this finished goods from a US parent for selling to the third party domestic customers in India, then this method is possible to apply. What this method tries to arrive at or how it is to be applied, Or why it is called resale? Resale obviously because Indian entity is purchasing the goods from abroad for its trading operations by way of sale to the third party customers in India. Here this transaction obviously leads to the either gross profit or gross loss. If the sale price is more than the purchase price or cost of goods sold, it will be resulting in gross profit, or it will be the other way around. What the method says is a very, very indirect way of justifying. Now in this transaction, what we have just discussed, that SSE imports the finished goods from a subsidiary, parent abroad, and sells the same goods to the Indian customers without any value addition. What is the transaction to be benchmarked for transfer pricing purposes? Anybody? What transaction need to be analyzed? Yes, speak out, no? It may be wrong, or don't worry. Correct. So this is the purchase cost we have to justify, right? What is the cross-border transaction is? Indian entity purchasing from the overseas related party. It is not the sale which is made in India that is the subject matter of analysis. It is an indirect way of justifying that what I am paying to my related party abroad is at arm's length. So how it is done? We work out the sale price as gross profit level, not the net level. Sale price minus the cost of goods sold, that is import cost mainly, and the custom duty applicable. We end up with the gross margin. This gross margin is being compared with the third party comparables in the same line of business. If we say that my margin is better than the or reasonable than the compared to the other third party comparables, we are at arm's length. Obviously indirectly proves that I am not overpaying to my related party. There is an indirect way of saying that my purchase price is at arm's length. If my gross profit was less than the average margin of comparables, that would have led to the other conclusion that I am overpaying, that's why the margin is dipping. So there is an indirect way, not that we have to benchmark the transaction in India, but we have to benchmark the transaction overseas, that is happening with the overseas company. So these are the various factors we need to consider. Of course, I am not going to the definition, as we have just referred that OECD also prescribes is one of the method, and they have just defined what is resale price and all that, but that we not go into the other nitty-gritties. Here factors which need to be considered is, ordinarily it is used in case of purchase and resale of tangible property. Reseller has not physically altered the product, that's why we consider in the example there is no value addition by the importer, and as it is the goods are sold the way they are imported in those same conditions. So even packaging, labeling or minor assembly are acceptable because the value addition is nominal, but we can make adjustment for that. How much value addition is made, 1%, 2%, and that can be considered while making the comparison with the other third party comparables. When we find out the third party comparables, we have to remember one thing, that these comparable companies have to be functionally comparable. Here, to some extent, product comparability can be diluted to some extent, but not that it is totally neglected. Some extent it can be diluted. Vis-a-vis, I am saying this cup method. In case of cup method, product has to be identical when you make a comparison in the prices. Here, to some extent, the product dissimilarity can be accepted, as you rightly said in case of mobiles or something. Here, direct price comparison may not be possible, but resale price is possible to apply. See, important thing I would just like to invite your attention. Now, that matter is becoming very, very prominent in Indian context, because what is happening in the Indian context at present or in the last 1 or 2 years is India entity is a trader which actually buys the goods from overseas, sells in the domestic market. At gross price level, India entity is at arm's length. When the gross profit is compared with the third party comparables and average of those comparables are taken of the margins, then Indian entity's margin is higher than the or equal or higher than the comparables margin on arithmetic mean basis. But when it comes to net level in Indian entity's profit and loss account, the net level India is in losses, the taxpayer. That is a peculiar situation happening in many of the cases. And what is the reason behind this? If you analyze this profit and loss account of Indian entity in this type of situations, one prominent reason, I am not saying that is the only reason, but one prominent reason is Indian entity is doing lot of advertisement, marketing and promotion. what is generally referred to now as AMP cost. And it is a huge subject which is being analyzed, talked about, and this has been discussed in High Court and Supreme Court judgments also. Namely, one can see LG Electronics as well as Maruti Suzuki judgment. That was the starting point, Maruti Suzuki, when this whole concept of brand promotion was discussed by the High Court. Of course, that decision went in favor of the taxpayer somehow. And LG decision is the very, very guiding principles are contained in LG decision. What ultimately it says, just for our today's discussion, is if you go by LG decision in this given context as a trader, where at gross level we are in having profit compared to the other comparables, at net level we are in either low margin or even negative margin. And because of this AMP, if there are some other business related expenses that we are not considering here, it is particularly talking about promotional activity or brand promotion that we are referring as AMP cost, which is incurred by Indian entity. In that case, what has been held by LG decision is they have made distinction between two types of expenses. One, product related, and the other, the brand related. So here, let us say in case of MNC setup, now the transfer pricing is applicable in case of MNC, maybe Indian MNC or foreign MNC. What is the decision saying? If Indian entity is incurring huge amount of expenditure, maybe coming under AMP cost, and that is not related to the sale of product, because India we consider the trader, so selling is their job, that is the main function. But apart from that, if India is incurring huge amount of expenditure of AMP nature for promoting the brand of the foreign company, then it is a questionable thing. What tax authorities are taking a view that that type of expense has to be isolated and that has to be benchmarked separately. If Indian entity is just incurring, let us say 10 lakh or 1 crore, let us say, of this expenditure, what they are saying that this is not your expenditure. First of all, this you are incurring on behalf of your foreign affiliate, maybe the parent. This step generally happens to the parent, that Indian entity is passing on the benefit indirectly, that they are advertising the brand of the foreign company or the parent in Indian market. They are virtually creating the new brand here, they are establishing the brand here. For that purpose, tax authorities are taking a view that this transaction has to be analyzed separately, and they may expect a hefty margin of 40-50% on this type of cost incurred by the AMP, by categorized as AMP cost. Because they are making, as I said, the distinction between product related expenses and brand related expenses. So this we have to see when we apply this resale price, because there are cases in live example that gross level we are okay, but net level we are suffering, maybe negative margin also. There we have to take this precaution. As in case of cup, RPM also is not free from some problems. First of all, how to find this valid comparables considering the functional and risk profile of the taxpayer? That is itself a challenging job. Of course, there are databases, we know that Prowess and Capitaline give this information, but how to compute gross profit even using this Prowess and Capitaline, that also poses challenge. Because in Indian context, the Schedule 6 requirement or anything doesn't give the working of the gross profit in the standardized fashion. So that again, when you try to compare the gross profit level comparison, there have to be some sort of adjustment, at least some sort of that way precautions to be taken when you apply this resale price method. One example will be, let us say, custom duty. Some people may be debiting the trading account, some people may be debiting the profit and loss account. If somebody taking credit that way, debiting the trading account, naturally the gross profit will be on the lower side.
So does it mean that in India we can or we should never apply RPM?
No. Even tax authorities are applying. It's not that we are saying that not to be applied. I'm saying we have to take precautions. When you compare, even using Prowess, at least one has to see that what type of comparison you are making. And if you are comparing like to like, let us say trader versus trader, sometimes what happens in database also, you know that there is a paucity of data in Indian context still now. So if a comparable company is having both trading as well as manufacturing operations, we go by this segmental data if it is available. Otherwise, people are going on the proportionate basis, which is also risky to some extent because one never knows what is the real result of the trading and manufacturing operations.
No, even in case of pure traders, in India there is no regulation which there is a standardization, discount on sales. Some people include it as a part of sales, some include it as a part of admin expenses. So that is bound to be there and there is no reason why we can be aware of it. And that is the argument which the department takes, that there is a inherent limitation of data which is there, that's why RPM cannot be applied. So, to some extent it is true also. So, what is your view, whether we should follow
See,
RPM or
basically, when you are saying that is not the case in case of all the comparables. If you see that what you are saying is right. As I said, custom duty debited or not debited, that is also specific. We can't find out from the profit and loss itself. But sometimes one has to take a chance also, because let us say TNMM, if you are running at a loss, and if the taxpayer goes and submit the analysis, I am having loss at TNMM on net level, TP will bound to be okay. You come, given a platter, I am making adjustment. So we have to live with this possibility. Or you are rightly saying that it may not be giving the exact working of the gross profit in case of particular comparable. That I agree that in certain cases there will be problems, but that is the reason that government is not going with the one comparable. That we have to work with a range sort of a thing.
Secondly, when we are talking about RPM, it requires very close functional comparability. What does this statement exactly means? Because suppose I am an exclusive distributor, so is it expected that my comparable also has to be exclusive distributor, or what exactly does?
Ideally, yes. When you are trying to find out, but as I said, there are some practical problems. One, even using prowess and Capitaine, we may not be able to get a particular bench, that way third-party comparable, which is exclusively in the same line of business.
Even from the annual report, we are not able to make it.
Correct. That's why I'm saying that there are some inherent problems in application of RPM. That's why we are saying that RPM is also not free from that way some problems. Just like CUP. CUP is having enormous problems, but RPM also has some problems, but to a lower side. If you say compared to CUP, RPM has lesser problems. Most will be in case of identification of comparables, as you said, pure comparables. Pure comparables will be a challenge, but one cannot say that there should be 100% like to like comparison.
Because in case of foreign MNCs who are having distributors in India, in initial year they are bound to be losses, because their overheads are bound to be higher than the comparables.
But that is the business case one has to explain. I am saying that as gross profit level there need not be losses. If at all some losses are there, that is initial years of operation, as you say, there will be because of the rates and taxes, office expenses, admin expenses, other SG expenses, what not. But in that case, the gross profit will not be affected to some extent, because that is the only sale and purchase price you are considering. So broadly, it should be giving the margin. That's why the situation I am considering the where I said that when I said Maruti Suzuki and LG decision, at gross level we may be better off, but at net level we may be suffering even negative margins, and that has to be explained by way of a business case. Why my margin is dipping? At gross level I am okay, but net level I am not. That one has to explain the business case.
And even we can make adjustment for underutilization of capacity or something like that.
That is possible, but in trading, what type of capacity are going to be used? In case of manufacturing, I can understand that manufacturing installed capacity there, unutilized capacity there. In trading, what sort of capacity there?
No, not capacity, but if our overhead ratio is 25%.
Correct. That adjustment is permitted, but you have to demonstrate that in the initial operations, what are your additional expenses. We have to identify and demonstrate to the tax authority that they are really abnormal cost, one can say, additional cost, which the other trader or comparable identified by you is not having. They may be established place in the market. But one has to demonstrate by your documentation. It's just because one goes there and tells the story that this is the case, they are not going to believe in that. They want some documentary evidence to prove that. Okay? This is one of the decision, as I said, in case of L'Oreal. That also only a part of reading material I have given, not that we are discussing at this discussion as such. Other decision is also Mittal Toys. And similar cases where they incur court systems and another L'Oreal case. Can we go to the last method?
Just one question, sir. In the first definition of resale price, it was mentioned that the flow of the transaction would be buying from the AE and selling it to the independent party. Does it work the other way around?
No, by definition, that's why I started with. There is a unique method in the sense that only direction part.
Yeah, direction is important.
If it is the other way, our regulation say it will be cost plus or TNMM. It cannot be RPM. The method is defined in our regulation to mean that it import and sell in India.
Okay, thanks.
Now coming to the last method of this today's discussion is what is called cost plus. And that by name itself one can infer what type of analysis will be involved in applying this cost plus method. Based on whatever two methods we discuss, anybody can share how the method will work based on this RPM discussion, we have to just say how the cost plus will work. Can anybody? No, I'm saying how it will work. That instance is right, that where it will be applied another thing, but how the method will work. When you say the cost plus method to be applied as a transfer pricing method, how it will work, generally speaking. Correct. It's as simple as that, right? We have to find out the cost and work out the margin what you are earned. That net margin or whatever you have to compare with the other third party comparables. The logic remains the same as in case of RPN. You have to find out the valid comparables, maybe functionally comparable. The product complementary to some extent further diluted compared to the cup and resale price. So one has to first work out the cost base. You have to apply the working of this margin, the sale price minus cost, whatever is the margin left, that is to be compared with the results in case of comparables. That is average results of the comparables. But here one has to remember that when you apply cost, it is as per the definition is cost of production. It's not the total cost. If you see the distinction, there is a slight distinction. Otherwise, the transaction net margin method and cost plus will be on same footing because TNMM considers the total cost, whereas the cost plus by definition in the regulations, it has to be applied at cost of production level. So that poses challenges. When the method says that cost plus, as we have discussed, the same thing it can be applied, but how to work out the cost base. In case of the taxpayer, it is possible to work out the cost base, right? Because in our company's data, we can find out to last level, you can analyze and find out what is the cost of production. But can the same thing done in case of comparables? Because comparables, as you also say, that we have to rely on the data of the provider capital line, which are third-party databases. How can we get some data? Even reading this annual report of the respective companies, we will not be able to understand what is cost of production. But what is available to us, general public, is the profit and loss account, which is published financials. From there, we need to work out what is the cost of production. That's why in cost plus method also there are challenges. So if one has to understand in cup there are challenges, resale price there are challenges, cost plus there are challenges. That's the reason that TPOs are inclined to more go cup because they want to make some sort of adjustment, and assessors want to go by the TNMM because that's the residual method, no problems. So whether or not cup to be seen, RPM to be applied, cost plus to be applied, general contingency of the taxpayer is that forget about it, I will apply TNMM and finish it off. Transaction at arm's length, finished. And he ultimately gets finished in the assessment also. Because that is the view many people are taking, and at the hands of TPO they suffer like anything. Because nobody is geared up to analyze the way TPO would like to have it. So even if it is talked that cost plus is okay, easy to apply, but how to determine the cost itself is a challenge. Forget about this identifier comparable. That is another challenge that he has already said. There are many challenges in applying RPM also, RPM and in cost plus also. So that identification of comparables is a challenge in all the methods. But here the additional problem is how to work out the cost, the way it is defined in our regulations. Now coming to this, what are the checks we need to consider before taking CPM as the cost plus, that is the most appropriate method. First, we have to ensure that inefficiencies do not result in higher profits as costs increase. Second, we must be taken into account that there is often no direct link between the amount of the cost incurred and the market price, that is arm's length price. Correct? There can be no link also. It is market determined price, one has to compare. And cost plus method requires extensive information about the cost base used in comparing the markups. Because unless the cost base is worked out rightly in case of company or the taxpayer as well as the other comparable companies, the results will be very, very different. And sometimes they can hurt us badly. And adjustments should be possible, as we say, capacity utilization, etc. But there should be some mechanism how to work out these adjustments. These are the relevant case laws. As I said, one is the L'Oreal and some, of course, this is incorrectly mentioned here that actually it was talking about as profit space was a TNMM, but unfortunately it has got pasted here. Net freight is not to be considered in cost plus. Just to summarize about these three methods. CUP, that is the method that compares the transfer prices directly with similar products or rather identical products sold or purchased in a independent, uncontrolled situation. Then RPM is when a buyer is that way buying from the overseas, selling in the domestic market. CPM for this method, the gross profit in the way it is, we have discussed that how to compare this profitability. Now, as we discussed, there are 5 prescribed methods, but sometimes it does happen. Of course, the other 2 methods will be discussed by Suchi in the later presentation, that I'm not touching premium and profit split. But all these 5 methods also are sometimes inadequate. Taxpayer feels, or there are some situations where none of the method, that is of these 5 prescribed methods, is workable. Because government is not able to, or even OECD is not able to think of the various new business models or new requirements in the present day context or practical circumstances where any of these methods will fail. That's why the government thought it expedient, or the CBDT thought it expedient to introduce or give liberty to taxpayer to apply what is called 6th or 3rd method, what is called as other method. And other method is assessor is free to apply the way he wants. There is no restriction whatsoever, so long as he is able to apply the method and explain to tax authorities what are the assumptions, how the method is devised, how it is explained, what data is used. Other conditions remaining the same, but it is over and above these 5 methods which are prescribed in the regulations. So that freedom is to the assessor to decide, or the taxpayer to decide whichever method in the given context, in the given business circumstances they want to apply, provided the adequate documentation is there, data is made available, the method is explained, how it is devised, how it works, and it is to the satisfaction of the tax authority. So that much liberty has been given by this other method. Now, where this other method can be used, in fact, some of the people are have done SDT analysis also here. So I will explain with respect to this one transaction which is very important in the SDT context, that is domestic transfer pricing, which was introduced in the last year. So March 2013 was the first year when taxpayers complied with the SDT requirements. One of the transactions we have just mentioned down below, bottom of the slide, is payment of directors' remuneration. Now let us say, just to give flavor, we have not done SDT analysis so far. SDT analysis is talked about in respect of the payments from specified people to the associate enterprise, local associate enterprise. As one example, he said that about allocation of this rent. That is the thing. Then when payer has to demonstrate that whatever one payment it is made to the associated person or associate enterprise, that is an arm's length. It still doesn't cover the income part. But in certain cases, yes, where tax holiday benefits and other things, income part is also covered. But just for today's discussion, we can understand that is mainly payment concern. So whenever a taxpayer is making payment to the associate enterprise in India for certain expenses which are claimed or which are covered under section 48(2)(b) of the Income Tax Act, that transaction is covered under SDT. So here we have taken the example of this method for payment of directors' remuneration. Now, anybody who has experience in working with many clients or companies, how the directors' remuneration is decided? See, here in SDT, the mandate is, let us say we are as a company paying remuneration to directors. How to justify, and it is a covered transaction, SDT. Company paying remuneration to director is a covered transaction, SDT. Company has to substantiate that this transaction is arm's length. So anybody can share his thoughts, how this will be done? Companies? Which sections? What it will say, but which range? But that's what the moot point, no? 5% limit. He is absolutely right. This is the way, because this method is not covered under any of the 5 methods. This is coming as a explanation of this other method. This is one instance we are taking just for understanding purpose. This method is not prescribed under the whatever prescribed list of 5 methods. It is a totally different way of justifying, because there is no other method possible to be applied in this case. Because if you see in company's context, there may be 4 or 5 directors, everybody's package will be different, depending on the qualification, age, experience, or service to the company. Many factors count. So in that connection, one cannot say that I am paying a director A this much amount, director B this much amount. Why there is distinction? Otherwise, within that there will be some adjustment. And how to demonstrate that even the maximum payment given to a particular person, that also is arm's length, or even minimum for that matter. In that connection, what she says is right. Time being, people are taking help from the provisions of the Companies Act because there are no standard guidelines and there is no way to benchmark the transaction to be at arm's length. So this is the example of other method which is permitted under regulation. But that's one has to remember that this is not yet tested at TPO level. These things will come 3 or 4 years down the line when the cases are selected for scrutiny for this March 13 as the first year of SDT. That people are taking, because same thing happens in case of RBI approval also. When you are making payment of royalty or other things, they will prescribe certain limit which is the maximum amount. One can still say whether it is the maximum amount which has been prescribed or it is the exact amount they should pay. So that issue will be tested, as I said, after 3 years maybe. So you have got good opportunity of justifying. You have done it.
Method only, or it can be any other way?
It can be any other, but I was coming to that. They have said that it should be price, information, other things. What can be given? I'm just coming to that. Or other, we can say, they are talking about, as you are rightly saying, price quotations, some data from third parties that they are trying. People are intent to say that this is the extension of cup method. People have gone to that extent, but you unfortunately may not be true, because the way she has said is not exactly the cup method she is applying. Correct, that's what I'm saying. No, one cannot say it's a cup, because you cannot have like-to-like comparison sort of a thing. See, sometimes what happens that quotations may be one thing and what is the final deal will be much different. Let us say quotation will be 1 lakh rupees for some transaction. After negotiation it will be ended at 80,000. One cannot say that that will be a valid basis. Quotation are quotations. So TPOs will be generally inclined to go by the concluded contract, concluded deals. So he is only a guiding factor that okay, these are the things need to be considered. That's why it's not giving an exact cup sort of a thing. If it is a concluded transaction, yes, that will be exact cup. So now just to summarize on these 3 methods, first of all you have to see the most appropriate method to be selected and applied based on the FAR analysis, what you have just discussed at length in the morning session. Each year is a separate year. Sometimes people ask, today I am using some method, can I change the method in future? Obviously the regulations permit that, but you have to have the justification, because even if the regulation permit, the tax authority will ask you. In the discussion at the time of personal hearing, they will compare, okay, last time your business model was this, there is absolutely no change in this year. What is that we are changing here that you want to apply a different method altogether? That one may have to explain at the time of assessment. There is no prohibition under the act as such that you can use the different method, provided the tax authority, if at all this raises the query, we are able to explain. Yes, please.
Commodity exchange quotes for the purpose of benchmarking.
See, as I said, these quotes are
they are actually traded. They are not quotation, but
correct.
actually traded.
That's what I'm saying, on the particular day. See, what happens, only thing that there will be in commodity exchange also, that is also a guiding principle one can say, because what is the transaction actually happening, that quality of the product may differ. There is no guarantee that whatever commodity exchange is suggesting, that will be of some standard quality. But what is the actual deal happening between two related parties is to be checked, that what type of purity they are talking about, or maybe of let us say chemicals or anything. One has to see what is the volume talked about, what is the chemical talked about, because volume discount to be considered, payment terms. The commodity exchange doesn't give you the payment terms, right? Correct. Only on the spot, but here the actual deal will be on credit terms also, on a letter of LC also, credit terms also. The business rate will be much different than what is available in the commodity exchange rates. So one can see as a guiding principle, okay, these are the things prevalent in that point of time when the transaction happened. And it has to be close to the transaction date also. When say I say my transaction is April, I can't use the commodity range of 3 or 4 months down the line. It has to be in the near vicinity. Correct. But we have to see the other factors, the contractual liability, contractual terms also we need to see. So we just cannot take it for granted that commodity is this, so my transaction arm's length. So we're coming to the close of the session. Thanks for patient hearing. Thank you very much. Any questions you can take, or you have some time, or you're running out of time?
No, I think we are a bit behind, but I think it has been quite interactive session. So So at the beginning of the session, Mr. Vishwnath Kane was a bit apprehensive that you had a sumptuous lunch, and even I was worried that we had vanilla and chocolate sauce also. So not only that has been absorbed and digested well, but I am pretty sure that concepts on the methods have been really very well digested because of everybody was so interactive, and that has led to making the concept very much clear on this methods, traditional methods. And the entire credit for this session goes to Mr. Mane. And may I request everyone to once again give a big round of applause. Thank you. We break for 10 minutes.